In business news tonight, the Monetary Board of the Central Bank of Sri Lanka has decided to reduce the policy rates, that is the repurchase rate and the reverse repurchase rate, by 50 basis points to 6.5% and 8.5% respectively, with immediate effect. Over the past several months, the CBSL has been following a procedure of easing monetary policy aimed at providing the necessary impetus to allow for economic growth to accelerate in the absence of demand pressures. The central bank is of the view that in keeping with the benign inflation and favourable inflation outlook environment, there is still further space to ease monetary policy in order to harness Sri Lanka's full economic potential and stimulate the economy to reach a higher growth trajectory in 2014. However, this view is not shared by all economic analysts. At the annual national conference of the Institute of Policy Studies in Colombo today, attention was drawn towards constraints on real economic growth in the country by the Deputy Director of IPS, Dr. Dushni Virakon.
If we take a look at the emerging trends in our external sector, there's nothing to suggest that anything has changed for the positive compared to the last 4 years or even 2 years ago. But it is important to recognize that a surplus on the balance of payments as a result of foreign capital borrowing does not mean that the underlying fundamentals of the economy are sound. We really need to work on getting a surplus on the current account, but that requires that certain constraints that impact the competitiveness and efficiency of the real sectors of the economy are addressed. Here, monetary policy really has no role. Monetary policy cannot address constraints in the real economy.